Well, we've had quite a wild ride over the last 2 weeks. So I see a lot of people becoming very emotional, starting to panic. So the first thing I'm going to do in the weekend report is we're going to take a step back, look at the longer term charts, and see if anything really unusual is happening. And I'm going to say no, it is not. So the first chart I have on the board here is a long-term 20-year chart of the S&P. You can see each one of these bull markets. This is the 12-month moving average here. During a bull market, at least until a multi-year cycle low occurs, they tend to, the monthly bars tend to hold above that moving average, and the moving average is advancing. When we get these back here, this was a 4-year cycle low, but when we get this multi-year cycle low, those tend to drop below the 12-month moving average. Those are much larger degree corrections. It's not only is it a degree up from the daily cycle, it's also a degree up from the intermediate cycle and a degree higher than the yearly cycle. So these historically have come about every 3.5 to 4.5 years. So you can see we had one here in 98, and you can see this cycle topped in a left translated pattern. It topped in less than 2 years and rolled over, and then that gave us the bear market that bottomed in 2002. You can see the monthly bars held below the 12-month moving average. Once we got our bottom, everything reversed. The moving average turned, started moving higher. Price, while from time to time it does tend to dip below it, by the time the month closed, the price ends up back above it. Then we get our top in 2007, and this was the point at which central banks really start to meddle in the markets, trying to force the natural movements of the market against what they want to do. This is where we saw Greenspan and Bernanke cutting rates, starting QE over here. So the market top at that point, it's a little bit harder to see in this chart, but we started to get these megaphone topping patterns, these wild swings back and forth as central banks try to halt the natural forces governing the markets. And with the real estate markets imploding and inflation starting to spike, the market was trying to roll over. Greenspan and Bernanke cut rates down to about 1%. And so they're trying to fight the bear market. So at that point, the topping process became a megaphone pattern. I think the odds are pretty good we're going to see the same thing when this bull market tops. The central banks just are not going to sit on the sidelines and watch everything unravel. They're going to cut rates to zero. They're going to do QE. So I just don't think there's any chance that a bull market or in our modern markets are going to top as just a quick a crash back down. I don't think that's even realistic in our modern markets. If this is a topping pattern, then I suspect we're going to come back up and we're going to go above it. We'll come back down, make a little lower low, and then another move back up as central banks try and fight the natural topping process. And it would take a year or more for a market to top in our current environment where central banks are very active in supporting the markets. But moving back to the multi-year cycles, you can see we had a very long multi-year cycle right here, a 7-year cycle. Now I'm gonna deviate just a little bit. I've been calling this a 7-year cycle, but I'm wondering if that's not uh, incorrect. This did turn out to be a 7-year cycle, and I'm wondering if we didn't just get a very short multi-year cycle that bottomed in about 2.5 years right here, because we did go below the 12-month moving average, and then now we're back to our normal 3.5 to 4.5 year cycle that clearly bottomed in early 2016, and now we're about 2 years into the next 4-year cycle, which would imply that our next multi-year cycle low is probably going to come sometime in late 2019 or early 2020. So since all of these cycles so far, assuming this was a short multi-year cycle, you can see they're all right translated. This one topped here, clearly didn't move below this low. Very right translated here. This yearly cycle or a multi-year cycle didn't nowhere close to moving below here. So we're kind of getting the signs of a secular bull market. That's what these secular bull markets do. The multi-year cycles right translate. So assuming that is correct, then it's just too early at this point for this multi-year cycle to top. We're only 2 years into this. The cycle should run, probably 3 to 3.5 years before this tops, and then we get our next multi-year cycle low in 2019 or 2020. So right now, all we're getting is just a normal pullback. We got stretched quite far above the moving average here in January, and we had very little volatility all year long. In fact, we've had very little volatility ever since the election, and we were due for some. And price got stretched quite far above the long-term moving average, and all we've done is we've come back down to tag it. Here's the chart of the Dow. A little bit stronger in the Dow. The Dow and the NASDAQ have been leading this bull market, but a little bit stronger. We haven't quite made it back to the 12-week moving average, but again, we just got a little bit stretched here, and now we're getting a pullback. Prices regressing back to the mean. And here's a chart of the NASDAQ, same thing. Again, a little bit stronger than the S&P. Price hasn't quite moved down to tag the 12-month moving average just yet, which could mean we may still have a little bit further to go next week, but clearly nothing unusual is happening. The chart of the transports looks exactly the same, as does the Russell. The Russell's been a little bit weaker. We did penetrate the 12-month moving average a little bit, but then the small caps are more volatile, so nothing unusual there. So one could, of course, ask, well, if the market had gotten a little stretched above the moving averages, why didn't we get on the sidelines? And the reason is that, well, my theory is that all of the years of QE are going to eventually create another bubble. I just don't see how we can avoid it. When the Fed went down this path after the bear market in 2000, it created a bubble in real estate, which then moved into the commodity markets. I don't think the result is going to be any different this time. So, there are some people that are calling for a long-term secular bull market that still has 10 years to run, and that very well could be the case. My theory, though, is that we're probably going to I think we're going to have consequences to all of that money printing. And so I'm in a little different camp. I think at some point here the market is going to go parabolic and we're going to have another bubble, and then the bubble will pop, and then of course central banks will step in and intervene again. So I'm not sure I'm in the another 10 years to go secular bull market camp. I'm more in the camp that says at some point here things are going to get out of control and they're going to get away to the upside. So just because the market is stretching above the long-term mean, that is not my signal to get out, because I don't want to get left behind if I am correct and we have a bubble coming sometime in the not too distant future. So just because price is starting to stretch above the long-term moving average isn't going to be my signal to get out, because if we're going to have a bubble, then we're going to get something that looks like this, that stretches extremely far above the moving average, and I don't want to miss that. So before we can get this, we've got to start with something that looks like this. So we're pretty deep into this. I think we're getting into the timing period where the consequences of 9 years of QE could start to play out. So I'm not going to automatically become nervous when price starts to get stretched, because I think at some point price is going to do this and go very far above the moving average, and I don't want to be out when that happens. A couple other things that I have gone over before, things that tend to happen at the final bull market tops. The last two, we had extreme divergence in the money flows as the tops were being put in. You can see here is the top in 2000. You can see how the money flows were diverging as smart money was starting to exit the market. Same thing here in 2007 as the Fed started slashing rates, as the real estate market started to implode, and we got a move back up, that, as I said, that megaphone topping pattern. Again, smart money seeing what was coming down the tracks started to sell. We just didn't get any kind of confirmation here at that second top. Not that this is a final top, but as we started to move into the timing band for this, what I think is now probably a 4-year cycle low, you can see smart money started to get on the sidelines in preparation for that. Big divergence in the money flows. We don't have that right now. The money flows have been strong. They are moving up along with the market. So no sign at this point that this is a final top. This is just we've just gone a long period of time without any volatility, and now we're paying the price with some pretty severe volatility. Another indication of a potential bull market top would be usually the advanced decline line will start to diverge, usually for several months. You can see here in 2000 the advanced decline line started to diverge as early as 98 as we put in this final top. Again, started to diverge early in 2007. The advanced decline line did not confirm this higher high. We just don't have any divergence in the advanced decline line at this time. So no signal that this is a final bull market top. So when we do get one of these big intermediate corrections, especially when it's a pretty extreme, pretty sharp, emotions kick in, and your brain tells you that there's no way that price can recover. But generally speaking, the first daily cycle out of an intermediate cycle low will more often than not will recover all of the intermediate degree loss before that first cycle even tops, or before the first cycle tops. And usually there's 2 or 3 of them in the larger degree intermediate cycle. So while it doesn't seem like it while we're in moving down into an intermediate degree bottom, the losses tend to get recovered pretty quickly once the bottom is in. So here was a fairly sharp ICL in 2014. You can see this first daily cycle recovered all of these losses very quickly, way before the first daily cycle even topped. Even during the 7-year cycle low, the rally out of the first daily cycle came up to test the all-time highs. It didn't make higher highs because this was a multi-year cycle low that was forming, but still, even notwithstanding that this was a multi-year cycle decline that was forming, still the first daily cycle tested the all-time highs. Once we got our final bottom here, again, the first daily cycle easily comes back up to test the previous intermediate cycle high. On the Brexit, the ICL right here, again, easily makes new highs during the first daily cycle. Again, coming out of the election, easily new highs during the first daily cycle here as well. And then, of course, the last intermediate cycle that we had has been very powerful. So very quickly did we recover these highs and move up. And I think the same thing is going to happen once we get our bottom. Maybe it came on Friday. We'll just have to see how next week plays out. But once we get our bottom, and we're we're going to be 56 days into this daily cycle, so it's due any time now. But once we get it, I think this is going to behave just like all the other rallies out of intermediate cycle lows. Before the first daily cycle tops, we're going to recover all of these losses, and we'll be back up testing this all-time high or higher highs. That's why I keep saying that I think we are setting up for a slingshot move out of this bottom. That will, if I'm right, if we are going to have a bubble, then this is when it should happen. It should have started in the fall of the year, and it should continue into the spring and maybe early summer. So, if I'm right and QE is going to generate more bubbles, then we're in that timing slot for it to finish that parabolic phase. And this is the correction that gets everybody on the wrong side of the market, everybody looking for a bear market, that clears sentiment, and then that's what sets the stage for the slingshot back to the upside. First daily cycle recovers the highs, and then we go on to stretch very far above that 12-month moving average like we did in 2000 with the NASDAQ. All right, just moving on to some sentiment charts, and these are from sentimenttrader.com. This is the source for all of my sentiment indicators. So to begin with, we've got the dumb money confidence, and this is, basically this is just retail traders. These are people that trade on emotions. You'll see, at bottoms, they start to project completely unrealistic targets. At tops, completely unrealistic targets on the top. So they are governed by their emotions. They are typically always on the wrong side of the market during, at these major turning points. They are the prime contrarian indicator. And you can see as we have moved down into this bottom here, the dumb money is getting bearish when they should be getting bullish. Now, I don't think that we need to go as deep here as we did back here, because this was a multi-year cycle low. This was a 4-year cycle low back here during this process. So I don't think we need to go as deeply to the downside during this correction as we did over here. And then moving on to the smart money, these are like the big hedge funds, the banks, people that have learned how to control their emotions. These people tend to get more bullish as the market goes down. And you can see this is exactly what is happening as the market has moved down and the dumb money retail type traders start to panic. This is when the smart money traders start to become greedy. And so we're, again, I don't know that this sentiment level is going to go quite as high as it did back here, because this was a multi-year cycle low, and this is just a very severe yearly cycle low. But you know, the chart is pretty clear. The smart money, the people that tend to make long-term gains in the market, are becoming bullish, and the dumb money is starting to panic. And then finally, I'm going to look at the intermediate term optimism index, which is basically it's just a combination of a lot of different intermediate degree sentiment indicators. I've seen, you know, a lot of people want to just pull one indicator, the investor's intelligence, and use that as an excuse for why the market is topping. You can't really just use one indicator. You need to look at a bunch of different sentiment tools to get an overall picture of where actual sentiment is, and that's what the intermediate term optimism index does. And so you can see here we're well into the excessive pessimism levels. We're at levels where you need to be looking at a contrarian play, time to go the other way. Everybody is on one side of the boat. It's time to go to the other side and go against the herd. So moving down to the daily charts, you can see at the bottom on Friday, we did complete a failed daily cycle. The market did move below the previous daily cycle low, and in reality, that's what should happen at intermediate cycle lows. It hasn't happened in quite a while because we've had such a calm market ever since the elections. But this is completely normal. This is what should happen at ICLs. Price really should form at least one failed daily cycle. So we've met that qualification, and then we've rallied back above it. So the first thing to look for would be a swing. Price would need to move above Friday's intraday high at 26.38. And if that occurs and we don't go back below this level, then that would be the first confirmation that we may have printed that final intermediate cycle low. And then the next confirmation would be to break the cycle downtrend line. Let me put that in for you. All right, so here's the cycle downtrend line. The first confirmation would be to move above this intraday high and also hold below the low. That would complete a daily cycle or a swing low. And then the next confirmation would be to break above this downtrend line. If once we take out that downtrend line, then we've got confirmation the cycle has bottomed, and we would be at that point we would be starting a new intermediate cycle. We're going to be on week 25 next week, so it's unlikely for me. I know some analysts are looking for a bottom in March, but I think we're just too late in this intermediate cycle. We're already going to be on week 25 next week. So I don't think we're going into March with this. I think we're going to bottom. We either bottomed on Friday or we're going to bottom probably next week, maybe very early in the week with one more slightly lower low. But right now I'm just watching this high. If we take out Friday's high, then I'd say the odds are pretty good that we put in the final intermediate cycle low right here. Once we break the trend line, then that would be probably the final confirmation that we would need that the intermediate decline is over, and we're then again in the advancing phase of another new intermediate cycle that would probably have anywhere from 15 to 20 weeks to rally, very similar to what we did right here. Moving on to the dollar, my expectation has been that we would get some kind of little bounce here and then move down to test this bull market uptrend line. Let me expand this chart a bit. All right, this you can see this a little better here. This is the bull market uptrend line. My thought is that this intermediate cycle would ultimately tag this before we get a final intermediate cycle low. However, we're at risk of forming a weekly swing if we get much more of a rally here next week. I would say the absolute max would be a test of this September low right here. Then we need to turn back down and tag this before the intermediate cycle bottoms. But if we get a weekly swing, that's going to come into question as to whether or not we may not tag this trend line. So I see a lot of people trying to pick a bottom in gold. At this point, let me switch this to daily. All right, at this point, we've got our resistance right here at the September low, and we're getting pretty close to it. I don't know that I would try and pick a bottom in gold until the dollar possibly tags this resistance zone. It's probably unlikely to get through that resistance zone unless this does turn out to be an intermediate cycle low. So it might just be a little bit premature yet to try and pick a bottom in gold. And moving on to the euro, you can see we're in a daily cycle decline here. We're getting pretty mature. Prices come down to tag this cycle uptrend line. It really should break it before we get the final daily cycle low here. So, maybe we need to test this triple top on the euro, just like we probably need to test that low in September in the dollar before this cycle finishes its daily cycle decline. So might just still be a little bit premature to try and pick a daily cycle bottom in gold. The euro really needs to break this trend line before we get our daily cycle bottom. This is just how cycles work. They need to take out all of the technical traders before the turn can occur, and that usually means we need to break these trend lines. That's what causes the technical traders to sell. They sell right at the bottom, and then price turns and goes back up. So if we're going to take out that, if we're going to test that bull market trend line in the dollar, and we've got a bear market trend line here in the euro at about 127 up here, if we're going to test those before these intermediate cycles actually turn, then we should have a little bit deeper to go in the euro, break this trend line, and then we get another cycle up that comes up to maybe test that bear market trend line somewhere right around 27 here. So looking at gold, we've got a support zone here right around $1,300 to $1,308 right here. So this zone right here between 1,300 $1,308 would be a potential support zone. If the dollar has a little bit further to rally and the euro a little bit further to fall, it's possible that gold still has a little bit more to fall before this daily cycle bottom. So I don't know that I would be in a big rush to try and pick a bottom, a daily cycle bottom here in gold just yet. And if the stock market has bottomed and we start to get a strong V-shaped recovery, that could also drain some of the buying pressure out of gold and give us that one more final move down into this support zone. And so while this big candlestick here in GDX, this does look convincing, as we've seen over the years, as our modern markets progress, these just don't signal, final bottoms anywhere near as often as they used to in the past. So at this point, I don't really trust this to be a final bottom. All right, moving on to oil. And I'm going to show you the same chart for the metals here and when I'm done also. I think we've probably started the intermediate decline. Price has gotten stretched quite far above this 100-week moving average. But unlike the stock market, the commodities just we're not ready for a strong trending market. So we're getting these choppy moves back and forth on either side of the 100-week moving average. It is turning up, but I wouldn't rule out a move back down to tag this before this intermediate cycle is over. We did, however, have a pretty big down week. It's a good chance we're going to get some kind of a bounce in oil here next week, especially if the stock market bottoms. But I don't think we're going to get a final intermediate cycle low in oil with just 1 week. I think we probably got further to go, even though we may bounce next week. Again, a look at the energy stocks, and again, we see this very erratic market bouncing around on either side of the 100-week moving average. It closed below it on Friday. Again, just these are just markets that are difficult to trade. You've got to time these wiggles pretty good to make money. Not easy to trade like the stock market that tends to trend strongly and stay above these moving averages. The commodity sector is just is very erratic right now. It's just we're just not ready to start a very strong trending market, I don't think, in the commodities. So they are difficult markets to trade, hard to make money in. And we've got the same picture in the gold mining stocks, just very erratic, bouncing around above and below the 100-week moving average. Just a difficult market to make money in. The GDX has come down to test this support zone. I don't think that the intermediate cycle has bottomed here. I mean, it is possible that we could just get one daily cycle and a final intermediate low, but considering how deeply the dollar is into that intermediate cycle, and at some point we're going to get a rally, and it may have started now. The dollar may rally into the March FOMC meeting. I just, it's just there is risk that, and I would say that the odds are very high that the metals have begun an intermediate decline. And yes, we will get a bounce out of a daily cycle low at some point, but then I think we probably have more to the downside. I think we're going to have at least 2 daily cycles in gold, even though the second one may be short. And if that's the case, the miners just have had a lot of damage done to them during this decline. They kind of got the double whammy. Gold was moving down, and the stock market was moving down, and the selling pressure from the stock market was infecting everything. So without gold moving opposite to the stock market, the miners just got hit exceptionally hard, and it's going to be probably tough for them to recover. So there is risk that the mining stocks, when gold does move down into a final intermediate cycle low, there's risk that the mining stocks could break down out of this lower band of this basing pattern and maybe even come down to test the yearly cycle low from 2016 down here around $18 to $19. So I just don't think there's any need to wrestle with this sector right now. It's just the odds are very high that we probably put in an intermediate top, and unless you time the moves back and forth extremely well, it's going to be very difficult to make money in the metal sector. So what I envision happening is that a lot of people have probably bought here on Friday, thinking this reversal candle was the bottom, and as I showed, it just may not be yet. The currencies may have a little bit further to go before they bottom, and if that's the case, gold may still have to get down to 1300 before it puts in a bottom. That could cause this to reverse, come back down, stop out everybody that bought on Friday, and then at some point we do get a bounce out of a daily cycle low. But unless you're just really lucky and can time where that bounce is going to top, it's just going to be hard to make money on the bounce. And then there would be risk that the bounce is a dead cat bounce and we start down again, and maybe we get our final bottom here in the middle of March when the FOMC meeting occurs. So for me, we sold right up here at the top, and I just I made one stab at trying to call a bottom right in here. We lost a little bit of our profits, and when that just didn't pan out, at that point I just decided the best course was just to we've got good profits, just to hang on to them and just stay on the sidelines and wait for the March FOMC meeting. And at that point, maybe we'll have something that I can identify as a final intermediate cycle low, and that's where I would be willing to take another shot. Right now, I'm afraid that we're just going to get into something that looks like this, that's just chews up both bulls and bears alike. So I just don't think we're gonna produce any kind of a trending move right now. So probably best just to avoid the metal sector for the next month and a half. All right, I know that was a very long report, but we've had a very wild and volatile week, so I wanted to try and cover everything. And so let's see what happens next week, see whether or not we get our swing low in the stock market. And for now, I think I would avoid the commodity markets. Both gold and oil have potentially started intermediate declines. The only market that is potentially forming an intermediate bottom is stocks. So the most likely place for a strong trending move would be to follow the smart money and get positioned or stay positioned in the stock market as we move out of that intermediate cycle low.